Good afternoon and welcome to the Wealth of Advice Market Update 9th of April 2020. Brought this market update to you a day earlier than normal, doing it on a Thursday. Obviously it's Easter weekend, but we thought there'd been some positive news to present to you this week, so we thought we'd go ahead and do a presentation today. Monday was a very good rate day for the financial markets around the world. All of them reacted positively. Basically that was on the back of the news that reduced infections was now being recorded all over the world, so that the effects of lockdown was kind of coming through. The US market grew by over 7%. There was also talk in there that the oil big oil providers in the world, the Russians and the Saudis, were having a meeting today, and there was going to be positive news to come out of that. I think that meeting's happened as we speak, and the markets are certainly up to date. On Tuesday, Japan announced a huge stimulus package worth $990 billion. This equates around 20% of its annual turnover, its annual output as a country, its GDP. Again, the markets like that. We're seeing these stimulus packages coming through. Wednesday was another positive day on the market. Sanders, who is a very sort of socialist politician, being described that he was like Jeremy Corbyn times 10. Stock markets don't like people like Jeremy Corbyn or Bernie Sanders. So them being him removing himself from the presidential race was a positive for the markets, and the US markets finished up 3% yesterday. Obviously in the UK we've had our Prime Minister Boris Johnson go into hospital. That, as I say, hasn't been listed on the things as being positive this week. The positive side of that was that the markets didn't suffer as a result of Boris going into hospital. Today our UK government has agreed an emergency deal with the Bank of England to effectively give itself a bigger overdraft that allows us to give relief. These helicopter payments that we mentioned last week, where money's dropping directly into the accounts of workers and both businesses. As I say, this hasn't been used since 2008. And the US government also today has announced a further 2.3 trillion of loans that's going to be available to businesses. How does that reflect in our client portfolios? We got this updated to the 8th of April. So we then ran it back to the 7th of February, so roughly 2 months worth of data. So those clients who had a notional £100,000 invested in risk score 2 and risk score 3, our core investment portfolios, but some of the Royal London portfolios will look a lot like this. It's just to try and give a flavour of how they reacted. You can see where those lows were reached around about the 20th or 21st of March. And now the risk score 3 portfolio is back up to 88,000, so around about a 12% reduction. Sorry, that's a risk score 2. The risk score 3 is 86,665, so like 13.5% reduction. But from the low points of when it was 20% and 18% down a few weeks ago, you can see how much the markets have come back. There is optimism from the fund managers who we speak that because the infection curve is reducing, that markets are going to do well in the coming months. They are saying that you should not be complacent. You shouldn't think that we are actually over the worst of the volatility that we've seen previously, but the levels of volatility is reducing. I've got a couple of graphs coming up which we'll go on to explain that. But why markets being positive? Well, Asia appears to be working again. We mentioned this last week. So output there is going to pick back up. And there's a definite expectation that the Asian economy will pull us out of this world pandemic. We've just had a conference call 3 o'clock today that went on for around about an hour with Legal & General, and they had an expert on pandemics and how this it's called an epidemiologist, and he predicts that we're going to see a W-shaped profile recovery from this crisis. This happened in the US during 1918 when the outbreak of Spanish flu took over the world at that point and killed lots of people. And what that means is a W-shaped recovery is when a country comes out of lockdown, allows people to move freely again, that you might do it too quickly, then you will see a spike in infections, you then have another lockdown, infections then reduce, and then the last part of the W is when finally we are over this, when everyone's being tested or when we've had a vaccine, and that's when the W is formed. We are believing that that's going to happen, and we were told the two countries that we really should be looking at close to home to see how this is going to pan out is Austria and Sweden. Sweden has decided not to have any kind of lockdown themselves so far, and Austria is going to come out of their lockdown on the 14th of April, so that's next Saturday. That's next week. So if that happens and you see Austria come out of that and they've done it too quickly, our government will look at that and that will help them decide what to do, because if you come out too quickly, you'll harm the economy later down the line. If you stay in lockdown too long, then you're going to harm the economy in the long term as well. So it's a very, very tricky thing, and no government has really done it before. Yes, you can look at the American story from 1918, but that, as I say, was over 100 years ago, and what goes on in the world then to now is totally different. Italy was obviously the country in Europe which was the first to really say was the epicenter of Europe, where infections went through the roof about a month ago. Well, they went on lockdown around about 24 days ago, and this is what the expert was just telling us on the call earlier, that 24 days is also the period from when you're infected to, on average, when someone will die from the virus, and they believe that their reproductive rate, which is again something we talked about a couple of weeks ago, has gone from the high figures above 4 per person being infected from every infectious person down to 0.8. And once that figure goes to a low level, that is when the government will then use that data to say, right, we'll open the economy, we'll relax the lockdown. Donald Trump again last night was saying that he wants the economy to come back with a bang. His experts and advisors behind him is not going to let him do that until the reproductive rate of the virus has gone below certain levels. I would guess that Donald will be quite keen to sort of get America back in the game quicker than other world leaders will do. So the positives from that is that Europe looks like it is starting to plateau. The cases are plateauing out. South Korea, who they were really strict on testing and movement of people, they're now down to below 50 cases per day, which is positive. China, we're still questioning the data that comes out of there. I know they threw a big party in Wuhan the other night when they were on to go back to work, which was a bit interesting to watch, shall we say, and it appears that their containment measures have now proven to be effective. So the previous slides we mentioned about investment risk. There's a market index called the VIX index, which records the level of risk that's out there. I'm not really sure of the maths that go into this. However, you can see over the past 12 months, the level of risk that a market was facing hovered along that 20 line. I think in January it was down around about 15. Well, from the end of January through February, as this outbreak increased, we reached a high point in the high 50s, early 60s, and then now that risk index is down to 43 today. So that shows you that the level of risk that out there is coming off. Now, markets will always tend to price themselves based on what the future is going to hold. So they're pricing today what they think 3 months down the line, 6 weeks down, whatever it may look like. So the fact that the risk index is reducing has got to be a positive thing for investors. As we showed earlier, investments are increasing value slightly. Risk is going down. That's got to be a positive thing for us. The next slide is an extension of the graph I've just shown you there, and it's a measure of risk going back sort of over 20 years. As you can see, 2008, which was the financial crisis, which engulfed the world then, the level of risk got up to almost around 80 there on that line. You can see that back at the end of February going into March, where we peaked, it was a lower level of risk than what it was in 2008. But the speed and the velocity of what's happened over recently is quite stark compared to what it was then. And then, as I say, you can see how levels of risk will then reduce down to what we call normal levels, and then hopefully we're not too far away from that. But again, if negative news comes out, if we do have a W-shaped recovery, as some of the experts are saying, where we release the communities, if you like, the lockdown ends too soon and we get a spike in infections, then you may see that VIX index shoot up again. But that's definitely a thing that we'll be looking at. Other positives to try and focus on. When the stock market falls by 20%, it's classed as a bear market. So quite clearly a bear market was achieved during the month of March, when markets all over the world fell by more than 20%. So a bull market is therefore by definition a market that increases by 20%. When the US market closed over 3% up yesterday, from the bottom of this market to that point last night, the US market is back in a bull market. We then look at how long bull markets will last and how much you're expected to grow over the next few years. The compelling statistic is that 5 years after most bull markets start, you are on average up between 60 and 70% in a regular balanced managed portfolio. But you can see there's been some periods there where bull markets have lasted a long time. The one that we've just come out of, which was from 2009 to 2020, was one of the longest bull markets in history. There have been previous bull markets which have been shorter, which have been higher, and obviously other ones which haven't done as well and have kind of petered out. But we are hopefully now in a position where we're over the worst of those stock market crashes. The financial stimulus and impetus that's gone in there has certainly sort of had an impact on the markets. Next week will be another short week, but what are we looking for? What answers do we want? We need to know how long these lockdowns are going to last for. How will the markets react if we hear that there's going to be another 3 or 4 weeks of no economic activity? France has released some data showing how badly affected their economy's been as a result of being on lockdown for almost a month. We need to see what the long-term damage is going to be to the economy. We believe that emerging as an emerged market, as an established market, the UK will come out with this. Our governments have set measures in place. The US, Japan, all the big nations are doing everything they possibly can. But how will the emerging markets cope with this? How will the likes of India and Africa and certain parts of South America really cope with the fact reduction in world trade? You're going to try and stop people from moving. In some of those countries, it's just not possible. So there's a fear that this virus will spread rapidly through those countries, and how will that affect world travel in the future? One of the Legal and General Fund guys was saying there, and this might be a bit of a blow to anyone planning on taking a foreign holiday this year or even early next year. They don't believe foreign tourist travel will be allowed to happen in the short to medium term, simply because you're not going to want anyone from another country bringing that virus in. Yes, we hear stories that there's still airplanes landing in Heathrow, but we're being told that they're just repatriating people from foreign countries, like UK people who are abroad, bringing parcels and other such deliveries in. Freight is the word I was looking for, bring freight into the country, and obviously diplomats and other things, people like that who have to travel. So the tourist travel is probably going to stay on lockdown for a long while. We need to see how consumer behaviours change in the future. We mentioned this previously, Netflix, Disney Plus, all these sort of streaming services are doing very well. Home delivery services, supermarkets, whilst they've sold a lot more food, have said it's cost them a lot more to supply that food. They're not going to keep up doing that. People are all working from home. Again, I'm in this office on my own this afternoon. Everyone else working from home. Will people want more flexibility in the future? You look at sort of London and how much it costs to rent office space down there. Will this trigger a lot of companies to say, well, actually, we don't need to have an entire floor of a building. We only need sort of half the staff here, the other half can work from home. There's all these things coming through, which ultimately might lead to more efficiencies, which could be good in the long run. So that'll be interesting to see how that sort of pans out. And then a big question, the guy in charge of the World Health Organization already had to go at Donald Trump yesterday, saying that he shouldn't politicize this virus too much. Well, Trump's already doing that. He's already blaming China for this. If he's going to use China as target to try and get re-elected and say it was all their fault, it wasn't my fault, where will that lead? Trade relations, we saw trade wars in between China and America in 2018-19, which brought the markets down quite a bit then. So again, this is going to be interesting to see how it all pans out from here. But yeah, thanks for listening again. It's a bit longer than we had last week. I hope you all have as best an Easter weekend as you possibly can in the current situations. Hope everyone stays healthy, and as we keep saying, if you need anything from us, just get in touch and we'll be happy to help.